All right. Good morning, everybody. This is JP Ruiz from the Entrust Group, and welcome to today's seminar entitled Tax-Free or Tax-Deferred, How to Pick the Right Account for You. The reason why we came up with this particular title is because we get asked all the time, which one's better for me, a traditional IRA or a Roth IRA? Mainly, the thing that people need to understand is what's the difference between tax-deferred and eventually tax-free distributions from your retirement plan. So that's going to be the focus of today. It's a simple differentiation between what is tax-deferred, what's the difference between tax-deferred, as well as the difference between that and tax-free. All right. A little bit of information on the Entrust Group before we get started. Entrust Group does not provide investment advice or endorse any products, although we are have been around for over 38 years, specializing in the self-directed administration of retirement plans. In other words, as a custodian, we don't offer any investments, but instead we offer a platform that allows for the individual to choose the investment they wish to hold in their retirement plan. All information and materials are for education purposes only. All parties are encouraged to pull in their attorneys and their accountants, as well as their financial advisors, to get advice from them, because that would not come from the Entrust Group before entering into any type of an investment arrangement. In other words, we will work with you and your tax advisor, along with your investment advisor, to go over the general rules. But ultimately, it's you, the taxpayer, that has to make the decision on what type of investment you're choosing to hold in your Entrust self-directed IRA. Again, the Entrust Group has been around for over, I guess, 40 years now. The last time I looked was 38, but I guess we've been around for 40 years, with over 22,000 accounts, as well as several $1 billion of assets under custody. In other words, we don't own those accounts, but we do custody. In other words, we safekeep those particular investments under retirement plans for individuals. Now, the Entrust Group has another company that is held by our founders, which is a completely separate entity. And the reason why it's a completely separate entity is because there has to be some checks and balances on who holds the assets as well as who administers it, so that for audit purposes, that there is no conflict of interest. In other words, they check each other out. The other company that I'm talking about is what we'll call the Entrust Trust Company, which is a trust company chartered under the state of Tennessee. In other words, it's governed by the state of Tennessee, and that is the trust company that custodies or holds the assets under the Entrust Group's administrations. One of the big difference between us and other self-directed administrators is that clients get to speak to people, because we still do have a customer service department that you can chat with, answer general questions. But again, they will always reserve the right to say, you know what, that might be a tax question or a legal question or investment question, and they will refer you back to your competent tax, legal, or investment advisor. The Entrust Group doesn't just educate our staff, but we also educate the industry. In other words, there are other financial institutions that avail of our education product, and some of which are certain designations such as the Certified Financial Planner Board. We do have a school called the Entrust IRA Academy that is approved by the American Banking Association, that prepares retirement professionals for what we call the Certified IRA Services Professional designation, which is through the American Banking Association's Professional Certifications Program. We are an approved continuing education provider for the Internal Revenue Service, as well as other major designations out there. Our programs do qualify for CE credits. In other words, continuing education credits or professional education credits. So some people that attend these webinars may be, again, certified financial planners, or maybe even real estate professionals that maybe are looking for continuing education credits. Our programs are approved for some of these designations. So what does the Entrust Group do? We administer what we call self-directed retirement accounts. In other words, the question is, what is a self-directed IRA? First off, the IRAs that we administer at the Entrust Group is no different than any other IRA that you could hold at any financial institution. It could be a broker-dealer, a bank, a credit union. It just so happens that the Entrust Group does not provide the last piece of having a retirement plan, which is an investment. Although we do hold the document and we custody the investment, we do not offer any investment. In other words, that's left up to you, the IRA holder, to determine what type of investment you would choose to hold in your retirement plan. And of course, there are certain restrictions on mainly two different types of investments, one of which are collectibles. In other words, collectible rugs, collectible cars. Somebody wanted to hold a collectible wine collection. Those cannot be held under your retirement plan. Another one are life insurance contracts, mainly contracts that have what we call endowment contracts, incidental to the death of an individual. In other words, term life. You can't have that under an IRA. And last but not least, S corps. In other words, an IRA is a valid trust under state law and cannot be a shareholder of an S corp. So therefore, you cannot hold S corps under a retirement plan. But for all intents and purposes, any other type of investment, including some precious metals such as American Eagle, gold, silver, and palladium, those can be held under a retirement plan. The reason why I'm sharing this with you is because in a self-directed world, it allows for you to diversify your portfolio a step further. It is regulated by the Internal Revenue Code, just like any other retirement plan out there. The platform, again, offers administration and custody, but does not offer investments to retirement plan holders. And with that said, it allows for you, the IRA holder, to diversify your portfolio. In other words, you can hold different sectors of investments, such as precious metals. If you wanted to invest in pieces of real estate, you can do that, which goes beyond the traditional stocks, bonds, and mutual funds. But again, it is up to you, the IRA holder, to do your due diligence on what you want to hold under a retirement plan. Last but not least, but it's not written in your slide, is what we call prohibited transactions. You cannot engage in any sort of transaction that is a conflict of interest. What does that mean? What that means is that you cannot invest in your company, or you cannot invest in a house that you live in. Those are some what we call prohibited transactions. The IRS has a wonderful portion of their IRS website that's devoted to what we call prohibited transactions and retirement plans. If you're not familiar with that, it's good to go to that frequently asked questions on prohibited transactions on retirement plans at the IRS website. But for all intents and purposes, a self-directed IRA could be a traditional, it could be a Roth IRA, it could even be, for some employers, what we call a SEP IRA, or a Simplified Employee Pension Plan, in which the contributions go into what we call a traditional IRA. And last but not least, a simple IRA. Although mainly I'm talking about IRAs, we do offer another type of employer-sponsored plan called an individual 401k plan. In other words, for employers who do not have employees, you can actually establish an employer-sponsored plan called an individual 401k plan, which has higher contribution amounts than your other types of plans. Now, the benefit of self-direction, as mentioned earlier, is that you can take control or make your own investment choices instead of being limited to the investments the financial institution offers. So therefore, if let's say you're driving by an apartment complex and you had enough money to buy that apartment complex inside your retirement plan, you can hold that under your Entrust IRA, whereas some other financial institution, they're not equipped or they don't have the infrastructure to do that. That's the difference between us and other financial institutions. Diversification is the key to maintaining your retirement plan balances. Why is that? Because if one sector of the investment industry is down, the other one is up. In other words, for example, if stocks and bonds, which is high right now, it's its highest rate. It's around in the 20 some odd thousand range. Well, guess what? Precious metals may be down. But if the stock market goes down, precious metals go up. Asset diversification is always advocated. As a matter of fact, you'll find that in any publications that talk about investing, such as your financial advisors, as well as the Securities and Exchange Commission. To learn more about the different types of investments available out there, I would say go to the SEC site, the Securities and Exchange Commission, sec.gov, or you can go to investor.gov, and it'll talk about the different types of investments out there that are available for investing. And those are the types of investments that you can hold under your retirement plan. Invest in what you know and understand. That's the best key into maneuvering through this ocean of investments available in the retirement space. Last but not least, given the fact that it is a retirement account, there are tax savings. And that's why the title of this course is Tax-Deferred or Tax-Free, because the benefits in a retirement plan are called tax benefits. So therefore, you need to understand, what does tax-deferred mean and what does tax-free mean? In other words, in some contributions, such as your traditional IRA contribution, as well as your employer plan contribution, contributions may be tax deductible. In other words, the contribution that you make for your own retirement plan can be used to reduce the amount of tax you'll have to pay for the year, whether it be an individual or if you own a company, or in other words, a business, you can use the contribution you make for your employer-sponsored plan as a tax deduction. Now, the earnings on these accounts will grow tax-deferred. That's one of the biggest difference between a retirement account and other investments that you have out there. As an example, if you have a brokerage account, let's say at a broker dealer, and you have stocks and the stocks pays a dividend, typically that dividend is taxable at the end of the year to the taxpayer, includable as taxable income in their tax return. In a retirement plan, the earnings grow tax deferred. That's the term, deferred. In other words, you postpone your taxation on the growth while it's sitting under the umbrella of your retirement plan. You can, of course, maneuver and change your investments under the umbrella of the retirement plan, and just like Vegas, whatever happens in a retirement plan stays in the retirement plan. In other words, the growth that you have is not going to be touched by the Internal Revenue Service until you take a distribution. The distribution will be determined, taxation of the distribution will be determined depending upon whether or not you have a tax-deferred type of plan, or another term, tax-free type of account. In other words, certain accounts reaching upon a certain time frame or criteria, the distribution of the earnings could be distributed tax-free. In other words, you won't get taxed on the distribution. That's why we get asked all the time, which one's better for me? A traditional IRA, which has growth that's growing tax-deferred, or a Roth IRA, which also has earnings that are growing tax-deferred, but with the main difference that when you distribute the assets, it'll eventually be tax-free if the taxpayer satisfies certain criteria. Now, before we understand the dramatic impact of taxation in retirement plans, let's take a look at the different levels of taxation that comes into play in retirement plans. There are typically 4 different levels of taxation. One is what we call the federal income tax. Because keep in mind, these accounts are federal accounts. In other words, the tax benefits for retirement are received by individuals under the federal tax code. So if you take a distribution out of an account that's never been taxed before, Uncle Sam is going to want their fair share. And that's what we call the federal income tax. Whatever taxable income you have for the year, if you take a distribution out of a taxable account, that amount of your distribution will be tacked on or added on to your taxable income for the year. And of course, for most of you, you may already know that the higher level of your taxable income, the higher level of taxation you may incur. And that's what we call our marginal tax rates, or our tax brackets. Even though we did get some tax breaks under the Tax Cuts and Jobs Act of 2017, effective 2018, you can run, but you can't hide from taxation. If you're going to take a distribution from an account that has never been taxed before, you're going to have to pay tax on those dollars upon distribution. Another type of tax individual taxpayers may be faced with is what we call the state income tax. Some states do have the income tax. I personally lived in a state called Minnesota at one point for several years, and we have 2 seasons over there, winter and road construction. So therefore, distributions are subject to state tax. Some states do not have state tax. So choose a state that you want to live in. Of course, some states are taxed more heavily than others. So the message of the story is you may be saving for retirement, but sometimes the thing that you need to take a look at is not how much you save, but also how much do you get to keep. We've talked about 2 different types of variables that will affect how much you get to keep. One is federal tax, and the other one is state income tax. The other taxation that we need to take a look at is the wealth transfer tax. And that could be either while you're alive or when you die. That's why they call it the gift tax while you're alive. If you give it to somebody else besides your spouse, that amount could be subject to tax, called the gift tax. And after you die, any amounts are transferred to somebody else besides your spouse could also be subject to what we call the death tax or the estate tax. But either case, that's something that people need to be aware of. Not only is it subject to federal, it could be subject to state. If you live in a state that you live that subjects retirement plan distributions as far as part of income tax, the federal gift and estate tax for individuals that have large enough estates that if it exceeds a certain threshold, those amounts could be subject to the federal gift or estate tax. And of course, the percentage for any amounts that go above what we call the federal state tax credit is 40% currently. Individuals also who inherit the assets from an individual not only could be subject to the federal and state income tax, they could also be subject to an inheritance tax. In other words, some states still have what we call an inheritance tax for individuals who receive assets from a deceased individual. Those are the types of taxes that individuals must consult with their tax or legal advisor, or in this case, estate planner, to make sure that they can minimize the amount of tax that they would have to pay while they're alive upon distribution, as well as how much taxes will be incurred upon their death. Which leads us to the different types of plans, one of which is what we call a tax-deferred plan. A tax-deferred plan, again, are your traditional IRAs, your SEP IRAs, as well as your simple IRAs. In other words, contributions to a traditional IRA are typically tax deductible. In other words, it's used to reduce the amount of tax you'll have to pay for the particular year. Another way of looking at that is that contributions to traditional IRAs that are deductible have never been taxed before. That's one type of asset that can be found inside retirement plans. And number two, the contributions could be invested. And that's what we talked about earlier, is that a self-directed administrator allows for other types of investments to be held under a retirement plan, unlike other traditional types of financial institutions. Now, the investment, of course, as an investor, our hope is that the investment would grow. In other words, you would have earnings. The earnings in those accounts are not taxed until such time that the individual takes it out. In other words, they take a distribution. So therefore, the moral of the story is, if you have a retirement plan, keep the investment in there, keep the growth in there, and those assets will continue to grow without getting taxed. In other words, the taxation is deferred or postponed until such time that the individual is ready to take a distribution. Now, tax-deferred accounts are typically made on a pre-tax basis, unless, of course, the individual cannot use their traditional IRA contribution as an example as a tax deduction. Therefore, what we call that contribution is what we call a non-deductible contribution. Those assets, since they're non-deductible, in other words, they've been taxed already, should not get taxed upon distribution. Why is that? Because they've been taxed already, assuming, of course, that the individual is tracking those non-deductible contributions using an IRS form. The IRS form is what we call the IRS form 8606. So in other words, if you've made non-deductible contributions, dollars that have never been used as a tax deduction, those assets should be tracked at an IRS form 8606. If you made such contribution and you don't know what the IRS form 8606 is, you might want to find out where that is, because that's your only proof that assets in your traditional IRA have already been taxed. And if you don't have that proof, that distribution for those assets that have already been taxed may be taxed again. In these particular types of accounts, earnings grow tax deferred. Well, what about the SEP IRAs and simple IRAs? These are what we call employer-sponsored plan contributions. And in some cases, employers may not have employees. Therefore, the contribution can also be made for the employer, because they're also an employee of the business. These contributions are made into what we call SEP IRAs or simple IRAs. The contributions made are, number one, used as a tax deduction by the employer, and number two, has a similar characteristic of a traditional IRA, meaning the growth on the earnings are growing tax deferred. In other words, the growth is not going to get taxed until it's distributed. The beautiful thing about a tax deferred plan is that, number one, contributions can maybe used as a tax deduction, so you have an immediate benefit of reducing your taxable income for the year. And number two, the earnings are growing tax deferred. In other words, the earnings are not getting taxed until such time that the individual distributes it, right? So that's one of the big benefits of a tax-deferred plan. And those are your traditional IRAs, your SEP IRAs, and simple IRAs. The advantages of a tax-deferred plan, again, in a nutshell, are no need to pay taxes on the interest. The growth can be distributed at any time. However, when you take a distribution, it's only then that you will have to face taxation. Contributions may also qualify as a tax deduction. In other words, it's an immediate benefit in the year of contribution because the taxable income for the individual could be reduced by the contribution made to the retirement plan. There are no income limits to making a contribution to a tax-deferred plan. In other words, a traditional IRA. No age limit for tax years 2020 and moving forward, whereas in 2019, before 2020, in years before, you could not make a traditional IRA contribution if you were have already reached the age of 70 and a half. Starting 2020 with the passage of what we call the Secure Act, which is a law that was passed and signed by President Trump in December of 2019. The age limit for making a traditional IRA contribution has been lifted. In other words, there's no longer an age restriction to make a traditional IRA contribution. Last but not least, if you're an employer and you want to reduce your taxable income for the year, meaning you did very well, you can reduce that by making an employer plan retirement contribution on behalf of your employees. And if you don't have any employees, that's even better. You only have to contribute on behalf of yourself. The contributions for those employer-sponsored plans go into what we call a SEP IRA. Now, keep in mind, a SEP IRA is nothing more than the traditional IRA, but it's just receiving a SEP contribution. So all the characteristics of a traditional IRA applies to SEP IRAs. Right? These are the tax advantages of a tax-deferred plan. The disadvantage of a tax-deferred plan is that when an individual reaches a certain age, the individual must start taking distributions because those assets have never been taxed before. Uncle Sam says when you reach a certain age, you're going to have to start taking a minimum amount, a required minimum distribution. That minimum amount, if not distributed, has a penalty associated with it. The penalty is 50%. 50% of the amount of that minimum amount that should be distributed every year. In the past, the age that the individual would attain to start taking those required minimum distributions was 70 and a half. With the passage of the Secure Act, that has been increased moving forward to age 72. Now, keep in mind, again, some people are a lot younger right now, but the moment you reach 72, you're going to be forced to start taking required minimum distributions upon attainment of age 72. Now, who is it good for? People whose income exceeds the Roth IRA limits. We haven't talked about the Roth IRA yet, but one of the things that's different about a Roth IRA with a traditional IRA is the fact that in a Roth IRA, in order for you to make a contribution, you cannot be rich. In other words, you can't exceed certain limits. We're not going to cover those income limits in this particular course because it goes beyond the scope of this particular course, but attend one of our contribution seminars and we can discuss the eligibility requirements to contribute for the Roth. But if people like the Roth IRA, you can convert existing traditional IRA dollars to a Roth. In other words, you can take a distribution from your traditional IRA and put that in a Roth called a conversion. The beautiful thing about a conversion is that regardless of how old you are, you will not be subject to a penalty. In other words, the penalty is waived. For people who need an upfront tax break, in other words, you are at a high tax bracket and you want to be able to reduce the amount of taxation that you have for the particular year, a tax-deferred account may be good for you. In other words, a traditional IRA if you qualify, or making a SEP IRA contribution for a small business. The maximum contribution, by the way, is the smaller of up to 25% of your income for the year, not to exceed certain dollar limits. For 2019, in which an employer could actually make that contribution and also establish a plan up until their tax return due date plus extensions, the cap is, again, the smaller of 25% of compensation, not to exceed $56,000 for 2019, and $57,000 for 2020. That's a lot. That's a big chunk of change that you could actually shelter from taxation if you're an employer. Simple plans are also for small businesses, but in this case with employees. If the contribution for a simple plan typically comes from the individual participant. In other words, similar to your 401k plan, it comes out of their pocket, comes out of their paycheck. Simple plans are ideal for employers with employees. The only thing that the employer has to make in order for the simple plan to be in compliance is that the simple plan employer must make certain mandatory contributions. And it could be a matching contribution or a profit sharing contribution. The matching maximum is up to 3% of the employee's compensation. Again, but if you don't have any employees, a simple plan may be ideal for certain individuals. But if you do have employees, a simple plan still may be ideal for certain individuals, assuming, of course, that the employee does not participate. Because if they don't participate, there's nothing to match. Again, these tax-deferred accounts postpone taxation not only on the contribution, but it also postpones taxation on the earnings. But eventually, the distribution will be taxed. It'll be taxed at the current rate in the year of distribution. One of the things a lot of people are worried about is how much taxes will I incur in the year of my distribution? Well, the first question I ask them is, when do you plan on taking distributions? And the answer is, most of the time, they don't know. Well, then, if you don't want to be up in the air as far as how much taxation you're going to have to pay upon the year of your distribution, which you're not sure of when that is, then you might want to consider what we call a tax-free plan. The tax-free plan means that although contributions may have been taxed already, because you don't get a tax deduction on a tax-free plan such as a Roth, but the earnings still do grow tax deferred, and eventually the earnings, if an individual satisfies certain criteria, mainly what we call those set of criteria, qualified distributions, the earnings will be distributed tax-free. That's a big difference. In other words, let's say you had $5,000 of contribution, and now it's worth $8,000. Guess what? The $8,000 is all yours without having to pay federal and or state tax. That's a big difference. For individuals who don't want to be up in the air as far as how much tax they're going to have to pay on a retirement plan, a tax-free plan may be something that they need to consider. Another set of individuals that need to consider a tax-free account are those people that cannot use their traditional IRAs as a tax deduction. And that's where your tax advisor comes in. Your tax advisor can walk you through the steps to determine whether or not you can get a tax deduction. And if you can't, you might want to consider a Roth, as long as you don't exceed certain income limits. Because in a Roth IRA, there are income limits. Okay, a tax-free plan characteristic. In a Roth IRA, contributions are not deductible, so therefore contributions have been taxed already. Those non-deductible contributions can be distributed at any time. As a matter of fact, in any Roth that you have, the first dollars leaving or being distributed out of your Roth IRA is always called contributions. A Roth IRA follows what we call the ordering rules. Contributions come out first, conversions come out second, and last but not least, if you still really want the money and you haven't satisfied the qualified distribution criteria, well, then the earnings are just distributed as if they were traditional IRA assets. So what's the moral of the story? Wait until you've satisfied the qualified distribution criteria. What's the qualified distribution criteria? You must have had a Roth, any Roth, for 5 years. And as a matter of fact, the 5-year clock for a Roth for a person starts from any contribution made to any Roth as of January 1st of the year for which the contribution is made. Once that first Roth satisfies the 5-year clock, you've satisfied your 5-year clock for all of your Roths for the rest of your life. Number 2, the only thing you'll be waiting for at this point is attaining age 59 and a half, death. You don't want that to happen, but that could be beneficial for your beneficiaries. And last but not least, disability. And for special circumstances, you can distribute up to $10,000 of the earnings from your Roth to purchase a first-time home purchase. In other words, you must not have owned your primary residence 2 years prior to the purchase of one. And up to $10,000 of your earnings can be distributed tax-free. Now, why are we talking about just your earnings? Recall that contributions to a Roth has been taxed already. Those can be distributed at any time. So what's the moral of the story in a tax-free plan? Wait till you satisfy the qualified distribution criteria before you take a distribution. So therefore, at that point, if you want to take a distribution, your distribution will all be tax-free. Advantages of a Roth. Another advantage of a Roth is that unlike a traditional, a SEP IRA or a simple IRA, which has what we call required minimum distributions when you reach the age of 72, Roth IRAs are not subject to required minimum distributions while the IRA holder is alive. In other words, when you're 74 years old and you have a Roth IRA, you are not required to deplete that account. However, once you die, your beneficiaries will now be subject to minimum amounts to come out in order for that account to be depleted, because Congress never intended for you to have a perpetual retirement plan. Distributions, again, are tax-free if requirements are met, and those are what we call qualified distribution criteria. If you want to read more about it, you can download from the Internal Revenue Service website a publication. It's called IRS Publication 590B. 590B. Distributions from these accounts also are not subject to the penalty if it's qualified. And of course, contributions can be distributed at any time, no tax, no penalty. Multiple penalty exceptions also allow for you to withdraw earnings as well as the contributions the moment you satisfy the qualified distribution criteria. You must have had a Roth of 5 years and one of the four: death, disability, attainment of 59.5, and last but not least, up to $10,000 of the earnings can be distributed tax-free for first-time home purchase. Now, who are Roth IRAs good for? People who expect their tax brackets during retirement to be equal to or higher than their current tax bracket. Now, unlike the message that you hear out there that you should be at a lower tax bracket when you reach retirement age, we don't have any control over that. Why is that? Because depending upon who's in power in Congress can either tax you a lot more or tax you a lot less. We are in an election year, and we don't have any control over that. We don't have any control over who's going to be in power. So we really don't know what tax bracket we're going to be in. So for those individuals that are worried about that, a tax-free account may be something you might want to consider if you qualify. People who want to pass on wealth tax-free to their beneficiaries. In other words, some people may not be saving their retirement plan for themselves because they have other sources of income already. If you want to pass on your retirement plan assets to your beneficiaries tax-free, a tax-free Roth may be something that you want to consider. People who want to lower their taxable income during retirement which would not affect other types of benefits such as Social Security. In other words, the more taxable income you have, your Social Security up to a certain percentage could be taxed. And let me explain that a little bit. For individuals collecting Social Security, you cannot exceed certain thresholds of taxable income to avoid taxation of your Social Security. In other words, for a married couple filing a joint tax return, I believe it's around $36,000 and up. You know, if your income is $36,000 and up, well, guess what? Your Social Security income as a married couple filing a joint tax return could be taxed up to 85%. If you are a single individual, I believe it's around 26 or 28. Check with your tax advisor. If your taxable income exceeds that amount, up to 65% of your Social Security income could get taxed. However, if you have a Roth IRA and your distributions are tax-free, well, that does not increase your taxable income for the year. Therefore, it doesn't affect your Social Security income. Some individuals may want to consider that in your tax planning for retirement. Last but not least, people who need more flexibility with their finances. Keep in mind, Roth IRA contributions can be distributed at any time, unlike your traditional IRA. Traditional IRA distributions always have taxes and possible penalties, whereas Roth distributions from contributions are never taxed nor penalized. In other words, you have access to those dollars at any time. Big difference between the two types of accounts. People who falls under certain income levels cannot have, fall above certain income levels, cannot have a Roth IRA. And here's a snapshot of what it looks like as an example for 2020, all right? For individuals with less than $124,000 of modified adjusted gross income, if you're a single filer, can make a full Roth contribution. Between 124 and 139, the contribution may be reduced depending upon your income. Above 139, you cannot contribute to a Roth. For a married couple filing a joint tax return, the phase-out range or the income levels are between 196 and 206. Under 196, full contribution to a Roth. Between the 196 and 206, partial contribution to a Roth. Over 206, you cannot contribute to a Roth. But it doesn't nullify the fact that an individual could actually make a contribution to a traditional IRA, because there is no income restriction in a traditional, and then eventually convert that into a Roth. However, taxation will have to occur in some cases from your traditional IRA. Check with your tax advisor when you're trying to determine whether or not you're eligible for a Roth contribution. Again, this is just a snapshot of what the phase-out range or the income levels, income restrictions are in making a Roth contribution. Now that you know the differences between the two different types of IRAs, if you'd like to make a contribution or you'd like to move assets to the Entrust Group, it's as easy as 3 simple steps. Number 1, open up an Entrust account. Number 2, fund your account with either a contribution, a transfer from another IRA of the same type, or a rollover from your employer-sponsored plan of a previous employer, such as a previous employer's 401k plan, 403b plan, or a governmental 457b plan. Last but not least, you can instruct the Entrust Group to purchase the investment that you have chosen. If I were to remind you again, the Entrust Group does not have any investment. So if you move assets to the Entrust Group, your account will just sit there without any earnings. So be prepared to invest your assets if you're going to move to an Entrust retirement plan. Well, again, we are done with the presentation of the material. What we'd like to do now is to open up the phones for any questions you may have in regards to the material presented. All right. Again, the first 40 minutes of this presentation was devoted to the materials. And now what we'd like to do is open up the phone lines for any questions you may have in regards to the materials presented. All right. Okay, the question we have right here, which has nothing to do with the current seminar, but I'll try to answer that anyway. Is Entrust going to allow for future purpose of publicly traded equities and a self-directed IRA in the future? I believe I've heard this is currently in the works, and the answer is yes. It is currently in the works. We're trying to open up a platform that allows for you to work with your financial advisor to be able to invest in publicly traded securities. Right? Okay, we do have another question. All right. I have another question. If I earn more than the maximum income level for contributions to a Roth, can I still open a Roth IRA by converting from a traditional IRA? The answer is absolutely. Now, keep in mind, if you're making a contribution to a traditional IRA, depending upon whether or not you use it as a tax-deductible contribution or not, of course, will determine the amount of your conversion. Now, keep in mind, when you do a conversion from a traditional to a Roth IRA, there are other factors that need to come into play to determine the taxation of your conversion. Meaning, Uncle Sam says, if you're going to take a distribution from your traditional IRA, you have to consolidate all your traditional IRAs. And you have to take a proportionate share out of the bucket that has been taxed and buckets in your traditional IRA that have not been taxed. So in other words, not only must you take the distribution that you didn't use as a tax deduction, you have to proportionally take a portion of each. And that's where the IRS Form 8606 comes into play. And with the assistance of a competent tax advisor, they'll be able to walk you through the determination of taxation of any distributions you have from a traditional IRA that's being converted to a Roth. But to answer your question, can you still make a contribution to a traditional and eventually convert that to the Roth so that you can make that contribution to the Roth IRA and start your 5-year clock in some cases? The answer is absolutely. Conversions do start the 5-year clock. Even though you're not eligible to make your own individual annual contribution to start the 5-year clock, you can start it by doing a conversion. That's a good question right there. Okay, another question. I have a self-directed traditional IRA that owns property with a non-recourse loan. If I want to convert this to a Roth, how is the value established? The value established based on whatever the balance is that is owned by the IRA. So in other words, you have an IRA that has $100,000 in it, and let's say you have a $20,000 loan, non-recourse loan. If you convert that traditional IRA to the Roth IRA, the taxation would only be on the $80,000, which is net the loan that you have, because the $20,000 is not owned by you; it's owned by your by the lender. So in other words, if you're going to convert from a traditional to a Roth that has a non-recourse loan, only the amount of principal that has been paid and that is owned by your traditional IRA will be the amount taxable. Now, as you pay back that loan, the more of the principal will be owned by the Roth IRA. That's the beautiful thing about conversions, is you're only taxed at the fair market value of that account upon conversion. So I hope that answers your question. Here's another question. Okay, this is in addition to the non-recourse loan. So if I want to convert this to a Roth, how is the value established? Is it the initial $40,000 I put down? Actually, no. If you have, in my example, $100,000 property, $80,000 is something that you had in your IRA, you borrowed 20%. Of course, every time a payment is made to that non-recourse loan lender, depending upon your amortization schedule, a portion of that contribution goes towards principal, and a portion of that goes towards interest. The principal increases the ownership that the traditional IRA has in the property. So in other words, if you put 80% down on a $100,000 property, that's $80,000, but you've made $2,000 of principal payments. Well, then the IRA owns 82% or 82,000 of the particular piece of property, which means upon distribution, upon conversion, the 82,000 will be the amount taxable, and not the 80,000 alone, but the 82,000, since the IRA owns 82,000 of it. So whatever the current principal, whatever current amount is that's owned by the IRA will be the amount that's taxable upon conversion. All right, let's see if there's any more questions. Keep in mind, again, the reason why we have this seminar is because it is contribution time. The contribution does not have to be made to the Entrust Group, but use that knowledge to be able to fund your retirement plans anywhere. And eventually, those can be moved to an Entrust account to purchase your self-directed investment. In other words, a lot of our clients own real estate, notes, private placements. As a matter of fact, we even have a precious metals platform that, again, depending upon how you want to diversify your portfolio, the types of investments will determine, whether or not it could mitigate risk for you. All right. So precious metals are one of those things you might want to consider, but of course, with discussion with your competent tax, legal, or investment advisor. Okay. If I convert today, when is my tax payment due? That's a good question. Conversions are taxable in the year in which the distribution takes place. So to answer your question, if somebody converts today, in other words, tax year 2020, the tax return due date for 2020 will be the date in which that tax will have to be paid. And that is April 15th of 2021. All right. So I hope that answers your question, that if you convert in 2020, the taxes have to be paid by the tax return due date in 2020. That's April 15, 2021. Now, keep in mind, in any distribution from an IRA, I'm going to take the answer further. You are allowed to withhold a portion of that distribution and send it to Uncle Sam, and the minimum amount is 10%. You can always withhold an amount larger than 10%. You can never withhold less than 10%. But another option is you can waive out of it. Sometimes, depending upon how old you are, waiving is the best option. Here's the reason why. When you're going to convert an asset called a traditional IRA to a Roth IRA, regardless of how old you are, the penalty is waived. Let's say you're 35 years old and you want to convert your traditional IRA to a Roth. It'll be taxable, but you will not be subject to the 10% penalty for any amounts that you convert. In other words, if you take money out of a traditional IRA, any amount you put into your Roth, right, those assets will not be subject to a penalty. So if you take a distribution of $10,000 and you waive the withholding, $10,000 go into your Roth, $10,000 is not subject to the penalty. However, in some cases, if an individual asks for an amount to be withheld, let's say, again, you're 35 years old, you're under the age of 59 and a half, you have 10% withheld on that 10,000. In other words, $1,000 goes to the IRS. And of course, when you send something to the IRS, you don't get it right back, right? When you send $1,000 to the IRS, how much goes into your Roth? Well, only 9,000. You know what that means? Only 9,000 of that distribution will be exempt from a penalty. The 1,000 will not only be subject to a tax, it'll also be subject to a penalty. So if you're under the age of 59 and a half, it is not advisable to withhold on the distribution, which means you have to prepare carefully for the tax liability on that distribution from other sources. Work with your tax advisor that if you're going to convert, plan first before you do the transaction. Because once you do the transaction, you cannot undo it. In other words, recharacterizations are no longer allowed for amounts that are converted. So if you go, I can't pay the taxes, you cannot undo that conversion. So plan ahead before you do the conversion. All right. I hope that answers your question. Next question. Entrust is my custodian. Will Entrust help guide me through the conversion? We can answer general questions, but as far as the tax liability concerned, that's where your tax advisor comes in, because we're not licensed to determine your taxable income. We're not licensed to offer tax advice. So, but the Entrust Group can walk you through the process. In other words, what paperwork needs to be completed, depending upon whether or not you want to do an in-kind distribution or you want to sell the asset and then convert cash. That's where we can help you through the process. But as far as tax issues are concerned, that's where your tax advisor would come into play to answer the questions you have in regards to the transaction. But definitely, the Entrust Group can assist up to a certain point, if that's your question. Yes. All right. We have a few questions. Again, this course is scheduled from 11 to 12, and so if you have any more questions, please ask your questions now in regards to the material presented. All right, we're gonna wait for another few seconds if there's any more questions. If not, we're going to call it a day. Again, if you enjoy some of these courses that we provide at the Entrust Group, please sign up or tell people to sign up as well. They don't have to be an Entrust Group current client, and if they are pondering whether or not they want to establish a self-directed account, sign up for our courses, and hopefully that can help assist them in making a decision with their competent tax, legal, or investment advisor. All right. Where can I see the courses Entrust offers? On our website, actually, we have what we call a learning center. If you go to www.theentrustgroup.com and look for the learning center. The learning center would include some of the courses that we have provided in the past. And those courses seem to have been beneficial for not only our clients, but for also pondering clients on whether or not they want to invest a portion of their retirement plans in alternative assets such as real estate, precious metals, private placements, notes, just to name a few. All right. So if you want to know where our learning center is, you can also contact contact us. By going to our website, we will have our contact information in there, and we'd love to chat with you and direct you to our learning center. All right. Well, if there are no more questions, we hope that you found this course to be beneficial for you. It's and helpful for you in making your decisions on the type of retirement plan you want to invest in, as well as what type of plan you might want to convert to in the future. My name is John Paul Ruiz, Director of Professional Development here at the Entrust Group, and we thank you for attending today's seminar, and we look forward to having you again in a future Entrust Group webinar. Have a great day.